Welcome to JM Financial Mutual Fund's Equity Outlook. In this short video, we would take a look at how different economic and market factors behaved in the recent past, but also look at our view on the Indian equity markets, which may in turn impact the positioning of our schemes. The Nifty index was down 6.2% for the month ended October 2024. The Nifty Midcap 150 index was down by minus 6.4%, whereas the Nifty Small Cap 250 index was down by 3.6% in October 2024. Sector-wise, Nifty PSU Banks minus 0.5%, Nifty Pharma minus 2.3% and Nifty Financial Services minus 2.4% were the top-performing indices, whereas Nifty Auto minus 13.0%, Nifty Energy minus 10.7%, and Nifty India Consumption minus 10.5% were the laggards. Global indices ended the month of October 2024. On a negative note, Dow Jones was down by 1.3%, Nasdaq was down by 0.5%, while Financial Times Stock Exchange 100 Index FTSE 100 was down by 1.5%. The India VIX saw an increase in October 2024. It was at 15.55 compared to 12.79 in the previous month, up by 21.6%. The Chicago Board Options Exchange VIX saw an increase in the month of October 2024 and was at 23.16 as against 16.73 on the previous month, up by 38.4%. Foreign institutional investor FII were net sellers for the month of October 2024. Net FII outflows were 91,934 crore rupees. Domestic institutional investor DII bought stocks worth Indian rupees 107,255 crores, whereas MFs were net buyers worth Indian rupees 90,771 crores. Nifty 50 forward PE trading greater than one standard deviation over the mean PE. Nifty Midcap 100 is trading near 2 standard deviation above the mean forward PE. In October 2024, equity markets were faced by an unprecedented exodus of capital by foreign portfolio investment FPIS and lower trading volumes as new capital market norms on margins began to kick in. The large cap index, BSE 100, declined 6.6% after reaching an all-time high in September 2024. Mid-caps and small caps also declined by 6.4% and 3.6% respectively. The FMCG index declined by 9.7%, which was surprising given it is viewed as a defensive basket of stocks. Other sectors such as real estate, metals, oil and gas, and auto experienced sharp declines. Record capital raised diverted funds away from the secondary markets, dampening markets further. Commentary from consumption-related companies was muted, as most companies spoke of a rural slowdown. Vegetable inflation and tightness in availability of unsecured credit appears to have impacted consumer spirits. The RBI's displeasure over high credit deposit ratios has dampened bank earnings. Stress in segments like microfinance, credit cards, and personal loans has resulted in higher credit costs. Government spending has also not kept pace with initial projections, and hence, while order books continue to grow, execution remains below expectations. In November 2024, U.S. election outcome is of great importance as also local elections in Maharashtra. This can keep markets on tenterhooks. U.S. elections promise to be a close one between the contestants. Regardless, the U.S. economy continues to grow above expectations and is likely to have record fiscal deficits, implying higher interest rates. Interest rates have nudged up in the U.S. in recent times, even as the U.S. Federal Reserve cut rates. We have summarized the key economic agendas of both parties and likely implications for India in subsequent sections. Central Bank RBI continues to remain cautious on inflation and credit expansion. India is still experiencing a higher degree of inflation in vegetables and some other food categories. Volatility in crude oil and edible oil prices are also issues that the RBI is factoring. This is impacting consumption more so in rural areas. Further, with banks becoming more conservative, flow of credit to smaller borrowers has declined and resulted in provisioning costs increasing for banks and financial institutions. This has resulted in credit growth slowing down to 11.5%. The silver lining is that deposit growth has exceeded credit growth, and this could reduce cost of deposits over the medium term. Slowdown in government capital expenditure. The recent growth in manufacturing and capital goods has been on the back of government expenditure towards roads, railways, and several other areas. Post-elections, we note a marked reduction in allocation. Fiscal prudence and changing priorities towards social expenditure, election-led, may be the reason for this reallocation. We expect capital expenditure companies to come off a high growth momentum, and consequently their high equity valuations may not hold. The central government capital expenditure has contracted by 15.4%, as against an expectation of growth. Will this lead to pent-up spending? India's stock market reforms and changes in regulation could have a short-term impact on trading volumes, which could lead to markets drifting lower. As the animal spirits wane and institutional money becomes more selective, it is reasonable to expect market breadth to decline with a narrower set of stocks outperforming their benchmarks. The quantum of capital raised by new floats and follow-on issues is at an all-time high, indicating that some of the cash holding by domestic and retail investors is chasing these new issuances. Corporate earnings slowing down. In Q2 fiscal year 2025, earnings are expected to remain flat, which is below market expectations. Lower corporate earnings momentum combined with higher valuations could imply that markets correct longer than we expect. Revival of markets will be led only if earnings growth picks up, which is expected in the next fiscal. Long-term themes remain intact. We continue to believe that long-term trends such as alternate energy, batteries, EVs, quick consumption will continue to do well in foreseeable future. Strategy. We expect markets to consolidate with a higher degree of volatility. U.S. election outcome may further refine our strategy. FPI inflows may not come back soon should U.S. economy exhibit strength and interest rates nudge up. India could then face some pressure as regards its currency, beneficial for IT and pharma. This could lead to sharp stock moves, and our preferred strategy is to be diversified across sectors and companies. This reduces concentration risk in the portfolio and helps it weather any single stock moves. We are conscious of a declining liquidity scenario in equity markets and a narrower set of stocks outperforming. We have increased allocations to defensive sectors such as healthcare, financials, and IT, and reducing our allocations to capital goods and automobile.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.